Welcome back to the weekly option. This is your host Eric, and this is episode 167 on May 21st, 2021. Again, I made this podcast is going to be using the end of day prices from Thursday, May 20th. And today we're looking at trades from Atossa Therapeutics, American Airlines, and Vale. So let's go ahead and take a look, get going here. So first off, looking at a covered call on Atossa Therapeutics, you can see the stock trading, at least on Thursday, it closed at $3.25 per share. So I was looking at buying that stock and then selling that 3.5 call, this June 3.5 call at 70 cents, which is going to give you a very nice, I believe, a 29% possible return in the next 4 weeks. And one of the things I like about this stock, I like this chart. I like that it's got a bit of an upward channel going that it's had for the last few months. And as long as it keeps pushing a little bit higher, I know it's right up against an area that could be resistance. But I think if it pushes through there, we have a good chance of this stock going much higher, closer to $4, or really about $3.75 is where I would look to see the next chunk of resistance here. So, but overall, it requires so little capital and everything is lining up. I really think this is a good trade. So hopefully it's one of the ones that you end up liking as well. Next up, looked at American Airlines. I've obviously, if you've listened to the show for a while, I've used these American Airlines trades for a while. I really do like some good opportunities often pop up. So this week, looking at selling the put spread here, this is still in June 18th expiration. So looking at selling this June 22 put and buying the June 21 put, which would be a total of 33 cents there. It's a $1 spread. So if we collect 33 cents for selling the spread, that means there's 67 cents of possible risk in this spread. And overall, American Airlines has had a nice it's come off a little bit, but it's had a nice grind. It's got several periods where it really was grinding higher. And so selling a put spread is a bullish indication. You're expecting the price to go higher, or at least stay where it is. And even if it stayed where it is, we lock in, we get to keep the money, the 33 cents we collect for selling the spread. But overall, I think the stock is going to continue to grind higher, especially as more people are traveling and getting the vaccine for coronavirus. I think things are starting to appear to look back to normal. So this trade, I think, has a couple of different reasons fundamentally and technically why I think it could work. And so that's the credit spread on the week, is selling that put spread. And finally, I looked at Vale, which is a Brazilian kind of metals and mining company. Stock ended the week at $21.07. It actually didn't end the week there. It ended on Thursday at that price. I'm looking at buying the June 2021 call spread. If you pay $1.56 for the June 20 call and you sell the June 21 call at 90 cents, so that gives you a price differential of 66 cents that you pay for the spread, which means that you'd have a possible gain of 34 cents because this is a $1 spread. So if stock stays above $21 per share at expiration, you'll capture a little bit more than a 51% return on your capital in the next 5 weeks. So that's it for today's show, for today's video. Thank you so much for watching. And if you haven't already done it, please do subscribe to this channel on YouTube as well. And that's it. Happy trading.